How's it going, guys? Welcome back to the Cashless Investors and welcome to another video about NIO. All right, my name is Nelson Kanyanga and this is the Cashless Investors. So I made this video basically based on what I was going through the comments. Okay, I was going through the comments of the last video and I found some comments that actually grabbed my attention. There was this person that had an average cost basis of about $57 per share. What I want to say is that I would not sell a single share. Yeah? And as a disclaimer, I'm not a financial advisor, but here's what I would do. I would not sell a single share. You probably bought the stock when it was rising to the all-time highs, and as an advice, do not buy stocks when they are very high on the trend. Right, wait for correction and buy it later. Right, don't get the FOMO, the fear of missing out. Wait. So investment in the stock market is about emotional intelligence. So you wait, then you buy. So now that you own NIO shares with such high average cost basis, what I want to say is that I would not sell a single share. I would wait and actually use the current market situation to average down my position. Yeah, the second thing is that there were some people that mentioned that NIO was not fundamentally solid. All right, as I said in the comment, that depends on your perspective. All right, so what do I usually do when I am looking for a company to invest on? First thing I do, I look into the balance sheet. I take the current ratio as my first guide. We're talking about a company with a current ratio of about 1.3. To be precise, 1.29. All right. That tells me that if things go south, the company is able to manage itself within 12 months with no issue at all. The company is fundamentally or financially solid for that period. We're talking about that's what the current ratio is for, right? It tells you the current asset divided by current liability. All right, so within the scope of 12 months, the company is fundamentally protected, financially protected. Now, if we see the percentage of intangible percentage of the total assets, NIO has less than 1% of intangible assets. That means that more than 99% of assets that NIO owns, they are tangible. This is very, very good. And now tell me, what are you going to think about a company that has cash on hand of about $6 billion? All right. So that's what I said. That's depending on your perspective. For me, that's super fundamentally solid. Yeah. $6 billion on hand. Okay. With a current ratio of 1.29. That's a company that I look for. And if we go to technology, man, NIO is perhaps, if not the most technological EV company that there is right now in the market. I would say NIO's technology is far ahead compared to Tesla's. Right? Tesla has the advantage that they are the early adopters. Okay, they are market share leaders in conjunction with BYD. All right, but in terms of technology, man, NIO is far ahead. Honestly, I said before, I've never been in a NIO, but what I've been reading and from my research, NIO is far ahead in terms of technology. Battery swap station, I'm not tired of saying that. That's something also that we need to consider as well. Now, NIO is a company that believes on what they are doing. All right. We know that they have been spending a lot on research and development, which we expect to decrease their numbers in order to have a much bigger gross margin. All right. We have been spending big time on research and development. As I said before, NIO is risky. Yeah, Estella is risky. We're talking about growth companies, right? So you need to bear in mind what type of investment you are making. So if you want to play safe, right, buy Coca-Cola, buy ExxonMobil, buy Chevron, all right, buy blue chips, buy companies, or buy Apple or wherever. Buy companies that have been in the market for more than 50 years or more than 20 or something. So consider that NIO is a growth company. All right, this is a company that is entering a new market. It's a new company entering a new market. So there is a lot of uncertainty, something that you need to bear in mind. So as I said, NIO is a company. It is risky. It is a company that for me is fundamentally solid, and it is a company that I am going to continue to average on. We're talking about a company with a cash on hand of $6 billion or more than $6 billion with a current ratio of about 1.29. We're talking about a company that believes on what they're doing, that believes on customer centricity. They put customers first, and that's a company that I see myself reflected on. All right. So guys, if you like the video, please subscribe. Let's get to 200 subscribers for this month. Okay. And see you guys in the next video.